There really is no easy way out of this. There is no soft landing and there is no miracle solution. It's not the end of the U.S. economy. It's not the end of the U.S. government. It's not even the end of the U.S. dollar. It's just a period of really dark, hardcore recessionary pain.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for May 23rd through May 30th, 2023, while supplies last. This week we feature the Ital Preziosi 10-ounce silver bars at just $3.49 over spot per ounce. Frequently, you have to choose between high-volume bars like 1,000-ounce bars to get low premiums, or pay a higher premium for more liquidity. But these Ital Preziosi 10-ounce bars not only maintain a great level of liquidity from a respected mint, but also boast one of our lowest premiums in several months at $3.49 over spot per ounce while supplies last. They come individually numbered, are available in any quantity, and come 50 to a box. They are also IRA eligible. If you'd like to learn more about a precious metals IRA, call us, and we'll be happy to help you in that process. To order these specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Matthew Piepenburg from Matterhorn Asset Management. Matthew, thank you so much for joining us today.
Great to be back, Elijah. Always a pleasure.
Well, it's great to have you. I did want to discuss the debt ceiling because that's really coming to a head right now. It seems like they're going to vote on a proposal here. Your perspective on what we've seen heading up to this proposal, and it seems like maybe some confidence has been shaken in the U.S. fiscal situation.
Yeah. No, I mean, it's important. Yeah, it's certainly an important question. I think the end is inevitable. America is not going to default on its U.S. treasuries, although technically when you're giving a negative returning bond, that is technically a default, but we've been used to that for years. So I think it's important to keep the larger context in mind. You know, since World War II, the U.S. between World War II and 1995, when we had that first real debt ceiling showdown between Gingrich and I think it was Clinton, we raised the debt ceiling 82 times. In 1995, it really became political. That was when it started to become the headline. And keep in mind that in 1995, U.S. debt, public debt, was $5 trillion, and the debt to GDP ratio was 65%. You know, fast forward to today, it's over 31 trillion, and the debt to GDP ratio is over 120%. But even in 1995, when Gingrich and Clinton were going at it, that was already a very politicized event. I think the next big crisis was in 2011, and that was when Obama and Boehner were going at it. And then finally, we have 2023 with McCarthy and Biden. But again, it's important to keep in mind that, when you look at where we started this in 95 with a $5 trillion government debt or public debt and where we are today at over 31 trillion, it just shows that red or blue, left or right, Republicans and Democrats in the U.S., as I would say, are two stirrups to the same saddle, to use an equestrian term. I mean, as different as they are, what they have in common is an inability to really, truly do what any family would do when they're over their skis in debt: curtail spending, change their lifestyle, cancel a few vacations, and stop pandering to lobbying groups or other things to stay elected and to spend like drunken sailors. What McCarthy has basically kind of agreed to, and we'll see if it actually happens, really is a $4 trillion expansion of the deficit or the debt, with a 2023 spending cap, but it's basically 2 years at this level of spending, which is effectively another $4 trillion. And already the Republicans on the side are screaming, with a Republican like McCarthy, who needs Democrats, because he's basically doing what Biden wanted. There's really no cuts in the proposal. And I haven't got into the weeds of it, and we'll have to see. But what I think listeners can take away from this, whether it's $4 trillion or $4.5 trillion or $3.6 trillion, it proves that both left and right ultimately will get their Andy Warhol 15 minutes of fame to show the world how strong they are and how convinced they are about a strong budget and a reasonable budget. But all this proves from World War II to 1995 to 2023 is that left and right politicians cannot seem to control their spending like normal Americans have to do every day. And so it's really more of a symptom. There are certainly members in both parties, and especially on the Republican side, that recognize this debt has to be controlled realistically. But the bottom line is the U.S. cannot afford, and the world cannot afford, for the U.S. Treasury to go into default. The banking system, the derivatives markets, international trade would just be a disaster. So something will happen. The idea that Biden can use the 14th Amendment at some emergency level is specious. Even as a lawyer, I know that's a reach that no court would probably accept. But again, it's a lot of political grandstanding right now to, in my opinion, get to the inevitable. They'll reach some compromise, and that compromise won't be much of a compromise because they'll have no choice but to raise this debt ceiling, which is hardly a ceiling made of anything more than paper mache. They're over their skis in debt. They're going to keep monetizing that debt. They're going to keep deficit spending until something breaks again and again and again. Enough things have already broken, but to me, the more things change, the more they stay the same.
Now, you wrote in your recent article that this debt situation is only going to make inflation worse. It seems like, the Fed is trying to raise rates and tamp down on inflation, which we're seeing a little bit, at least if you look at the official numbers. But this whole debt situation, if the government just keeps spending, that's just going to make inflation worse. Look,
there's no easy way around it. There's a great quote by Larry Lepard. You can't taper into a Ponzi scheme when you're printing and printing to monetize your debt. In the past, the U.S., whenever there was a problem, a military problem, a social problem, a market problem, a budget problem, they could throw money at it, make it go away. And they could throw money that's mouse-licked at the Eccles building. When you have inflation, you can't throw money at an inflation problem without making it worse. And there's no way around that. In the meantime, by expanding their deficits and by going deeper into debt, they're basically keeping output costs and demand at an artificial high, which actually increases prices, everyday retail prices and manufacturing prices. So, and even labor prices are going to have to match that despite labor woes. The irony is by keeping this economy on a debt respirator, by expanding the deficits, you actually put more tailwinds to the inflation. And Luke Groman did a brilliant report on this. I think Luke Groman's probably one of he really spends the time day after day after day looking into the weeds and then explaining those weeds very, very competently and simply to the rest of the world. But I can't take credit for that analysis, but I totally agree with it. And again, the inflation trap we're in right now, I think we're basically 5% CPI, which is significantly less than 9% last June. So you can say that this austerity or this tightening light, letting bonds go to maturity, reducing the balance sheet by 2%, raising rates to 5.25%, has had a disinflationary effect. There's a couple of things I'd say to that. First, you have to always keep in mind this isn't conspiracy theory. The official CPI number is probably underreported by at least 50%. So we still have sticky inflation. There's another. I've got to give kudos to Mark Valek and Ronnie Sturfler, our advisor at Matterhorn, just came out with the Gold Trust Report, the 2023 version, which is fantastic. There's a large section there about inflation, including an interview with Zoltan Pozner, which is really quite impressive. And as Zoltan said, the chance of getting to target 2% inflation is like a snowball's chances in hell. It's just not going to happen. And I think the pressures on inflation are evident everywhere. For one thing, we've chronically underinvested in resources and we've not managed labor. So labor and wages are going to increase as costs in natural resources are going to rise in the U.S. in production. So we still have these inflationary tailwinds. We have no choice, in my opinion, at the end of the day, but to print more money as well, which is inherently inflationary because we have to monetize the U.S. Treasury to keep yields from spiking too high. But it shows that the Fed is really in a corner. I think even Warren Musler said that it's chasing its own tail. There is, when you have inflation, an inflation premium. No one will buy your IOUs or U.S. Treasuries if they're not beating or matching inflation. They're just not attractive. And so you have to have a higher interest rate to keep that U.S. Treasury appealing. And as we saw last year, there was a massive dumping by foreign central banks of U.S. Treasuries and a massive buying by foreign central banks of physical gold. And so since Uncle Sam lives off its IOUs, that dumping of Treasuries is very dangerous. So they're caught in this total trap. They need to keep rates somewhat high, not just to fight inflation, but to make their Treasuries attractive. But if they raise rates to keep their treasuries attractive, the U.S. is also responsible for paying interest on those treasuries and on those obligations. So they're in a trap of trying to keep this premium, this inflation premium, keeping the treasury attractive. At the same time, Uncle Sam can't even afford his own debt levels. And so, in my opinion, at some point, the only buyer of those treasuries, if it's not foreign central banks, and there has been an uptick in household purchases of U.S. treasuries, and household purchases of U.S. treasuries include hedge funds. And you could argue that the U.S., like Japan, is buying its own debt and that would cover the gap, but it's actually not covering the gap. And frankly, most hedge funds are buying U.S. Treasuries, even knowing that they're taking a loss, because in a sense, it's a cash equivalent, and they'd rather lose 1% to inflation so that they can buy when these markets go upside down. And so I think, the Fed is really in a corner. The only way to really fight this inflation, I believe, is through engineered recession. And the idea that they can manage that in a softish-like landing and control that, I think, is beyond the pale of honest at this point. You're seeing so many stressors in the middle class, and you're seeing so many indicators of recession, whether it's the PMI index, whether it's the Conference Board of Leading Indicators, it's gone negative. For the last 60 years, every time that goes negative, that's a recession. You've got contracting credit. You've got contracting M2 money supply. You've got an inverted yield curve. You've got a major spread between the yields in the 2-year and the 10-year. There are just neon flashing signs of a recession. The recession always clips the middle class the hardest. And so, in this effort to try and save the bond market, they're crushing the middle class. Of course, we know they're crushing regional banks. They're crushing treasury markets. They're crushing small businesses. And in another way, they're also leading to inflation in the real estate sector, because if you're a homeowner today and you have a current home and you sell it and then you buy a new home, you're going to have to buy it at a higher mortgage rate. So current homeowners aren't looking to sell right now. That means new house construction, the prices of new homes are going up about $25,000 per home across the median. So we're seeing price inflation in new homes. We're seeing current home buyers sticking to their homes. And so it's an absolute conundrum. It's an absolute mess. The Fed really is cornered, and to monetize and save their bond markets, their precious IOUs, and to quote unquote fight inflation, they're raising rates. We can't even afford our own rate hikes, and we're actually in a lot of ways stimulating further inflation. And the idea that, well, we're at 5% CPI, something must be working. I don't think it's working if you're breaking so many things. People keep saying, when's the recession? Again, I'd say it's already here. There's manifold evidence of it, but it's only just beginning. More and more things are going to break. The next thing will probably be the labor market. People keep asking, when's it going to get bad? It's already so bad by so many indicators. I mean, regional banks fail. When you have to bail out depositors and let the banks fail, that becomes very expensive. And again, when credit markets fail, when stock and bond markets see their worst return last year since 1871, what more do you need? What we'll see at some point is a major crash, like we saw in March of 2020, or of course in 2008 in the fall. And when that happens, the Fed will do what it always does. It will reverse course, start reducing rates, start creating more liquid synthetic cash, liquidity, QE, and that will be inflationary as well. But the only way to truly be disinflationary or deflationary is a recession. And we're going to have the mother of all recessions, in my opinion, based on the indicators we're looking at. And of course, that hurts the middle class the most. And so, that's why we're really seeing a trapped central bank with a lot of platitudes replacing really bad math. And we're actually, in many ways, encouraging inflation with our own policies to fight inflation. Of course, my thesis has always been that the Fed wants to have his cake and eat it too. They really do need inflation. They need negative real rates to inflate away debt, but politically they can't be arguing for inflation. So they'll underreport or misreport inflation, and that way they have their cake and eat it too. The problem is they still have the arrogance to believe that they can stovepipe and control this inflation problem, or this, by managing with interest rates. What they're not seeing is the ripple effects and the collateral damage from, again, small businesses, real estate, bond markets, banks, the whole mess. And again, these trends are only just beginning. They're not in our rear view mirror. So I'd say it's already a failed policy, and we haven't even seen the worst of it yet.
Can you expand on how a lot of this war on inflation is actually backfiring? You mentioned, for example, in real estate, how actually rising interest rates in this situation can cause further inflation there, ironically. But it seems like, when Paul Volcker raised interest rates, that tamped down on inflation. So how is today different than what we saw in the 80s?
Well, the main reason it's so different is America, not just at the public level. Government debt in the 80s was under $1 trillion. It wasn't over 31 trillion. And so Volcker had far more range to raise rates without destroying everything. Although there was a recession after the rate hikes, it just wasn't a prolonged and sticky and painful and miserable one like the one we're heading into. And just like as the U.S. government debt wasn't as high, neither was corporate or household debt. Because again, when you combine corporate, household, and public debt in the U.S., we're over 94, 95 trillion in combined debt. So these rate hikes at that debt level are far, far more painful. And look, inflation and rising rates, like I said, kills a lot of things. It certainly kills tech stocks. It kills the tech sector. You look at the ARK ETF. I can't even. It's ridiculous. It's kryptonite for bonds as well. We saw that across the whole level of bonds, not just treasuries. We saw it in investment grade to junk. It also leads to credit contraction, which is incredibly recessionary. So, again, it is not the era of Volker. I think I read in Ronnie's report comparing. What was it? He said comparing Powell to Volker is like comparing Carrot Top to Brad Pitt or something like that. It's just a joke, or Danny DeVito to Brad Pitt. They're totally different eras, totally different debt backgrounds, and totally different weaknesses. And again, it's just an example. When you're artificially stimulating the market through deficit spending, you're still allowing price demand to go up. So that's actually a tailwind for inflation. And in the case of new housing, which is a major part of our economy in the real estate sector and the real estate kind of markets, when new housing costs are spiking, because they can demand higher rates and higher prices because there's a less of an inventory in current or existing homes. There's just simply less supply of inventory, so that pushes the price up, and that's a major part of an American citizen's expense. It's their car, it's their house, it's their education, it's their food. So again, we're not going to see 2% inflation target hit without a scorched earth policy. I think I wrote in my last article that using rising rates at this speed, at this late in the game, at this speed, at this depth, to solve an inflation problem is like trying to get rid of a mouse in your kitchen by putting, dynamite in the sink. It's far too much, too fast, too late. And we're breaking so many things. And as I said in prior interviews, it wasn't just these things in the U.S. markets, at the middle class level, the retail level, the small business level, the real estate level. It was at the even affected global markets, like the gilt response in last October. We saw the U.S. Treasury response in March 2020, and then we saw bank failures in March of 2023. So many things are breaking because of Powell's hawkish policy. And again, the big question now, and it was the kind of the theme of the In Gold We Trust report that came out just a few days ago, it's called the showdown. Is the Fed bluffing, or are they going to continue to raise rates to fight inflation and to put this premium on inflation? And I think, the argument Ronnie and others are making is at some point, as the markets predict, as the Eurodollar futures market predicts, as the oil futures market predicts, as the equity markets predict, there's going to be a market collapse of some major form in 2023, which will force the Fed to reduce rates and start printing money to support the bond market, to keep bonds from falling too far in price because there's so little demand and yields spike, and that's destructive. But there are others like Poser who think, don't hold your breath. Rates can go higher for longer. You've got Bullard and Neil Kashkari saying that. They're seeing things in a stovepipe, though. These Fed officials and these pundits, they're seeing it. We've got to fix inflation, but it's like the dynamite to kill a mouse. You're going to break the sink, the washer and dryer, the door, the hallway, the roof, and the ceiling too. And so there really is no easy way out of this. There is no soft landing, and there is no miracle solution. It's not the end of the U.S. economy. It's not the end of the U.S. government. It's not even the end of the U.S. dollar. It's just a period of really dark, hardcore recessionary pain, followed by, in my opinion, an ever-increasing geopolitical switch away from the U.S. dollar as a trade settlement currency, and a changing bipolar, multi-block economic system and currency system, all of which eventually affect gold. But this inflation problem has reared its head, and there's no easy solution. The most obvious is a recession. That recession will be followed by more mouse click money and hyperinflation or extreme inflation. So you'll see inflation and deflation cycles, in my opinion. Right now, we're still in a very sticky inflation cycle. If Powell really wants to kill inflation, he'll kill just about everything and everyone with it, and then he'll claim Roma Victoria over the rubble of a very, very deflated, recessionary/depressionary U.S. economy and market.
And how will that affect the middle class and small business? Because it seems like there are some ways in which there's been a lot of centralization and merging of some companies. I mean, one example is obviously First Republic Bank, got taken over by JP Morgan there. So it seems like we're seeing greater and greater centralization, which at the end is not good for the average person.
Well, I'll call and raise you. I mean, look at UBS and Credit Suisse and the Swiss National Bank effectively forcing a merger and basically screwing the bondholders in favor of the shareholders. They basically broke their own rules. So there's just more consolidation. mean, how rising rates and how inflation affects the middle class more than others is, I think, palpable. First of all, as the Small Business Administration just came out with a report, I mean, loans that the banks give each other in the repo markets, or loans at the too big to fail banks, or the interest on excess reserves that they get from the Fed, are far more lucrative to the big boys than they are to the middle class little boys, or the medium-sized boys. I mean, an average loan for a small business is now in the double-digit range. And so that is clearly going to be painful. They're going to have to either cut costs or cut labor because they can't get the same extend and pretend loans that they used to get 5 years ago, 4 years ago, or even 3 years ago. So debt is essential to small businesses as much as it is to S&P companies. And even S&P companies used to use cheap debt to buy back their own shares or to roll over tomorrow's debt and pay for the next day's loan, or today's loan to pay for yesterday's debt. That debt rollover policy, that extend and pretend policy, and that share buyback policy, which is a major tailwind for the big boys, has been curtailed. But for the small businesses, which is the backbone of what used to be the American middle class and what used to be the strength of the American economy, which is now being eaten alive by the Amazons and the Walmarts of the world, those small businesses are struggling because they can't afford higher costs of debt, higher costs of money. And you're going to see more layoffs. It's just beginning. When big tech companies fail because of inflation and rising rates, those are people who usually have a lot more money to live off of before they start going to the unemployment lines or working at Starbucks. They just won't do it. But the smaller businesses and the smaller employers of local employees are going to feel the pinch of this inflation and this higher debt cost more than others. But again, this is just another example of how the Fed and the powers that be have rigged to fail this system so much in favor of the top 10%. Again, the top 10% has gotten more than 90% of all the benefit of the S&P rise since the QE1, QE2, QE3, since this so-called Fed stimulus. The major beneficiaries of that have been the top 10%, the upper middle class or the ultra rich, whereas the middle class has been eclipsed. And, in addition to that, now the cost of debt's going to be harder. You're going to see more and more small businesses fail and more consolidation by the bigger boys, even up the smaller ones. It's just a classic trend of how the middle class has been completely left behind by the so-called Fed, which Bernanke and Powell and others have said doesn't affect social unrest or affect social situations. It has a direct effect on wealth inequality, class consciousness, social unrest. That's part of the reason we see so much splintered and identity politics today. It's ultimately financial. It's not just social or identity politics on race or color or left or right. It's broke and not broke, and those who have and those who don't have, and that creates problems. As we talked about before this, though, I think one of the most important things about the middle class and the way inflation and currency debasement and rising debt costs have really affected the U.S. in such a grotesque way, and especially the U.S. middle class. Compare it to China. What just happened in the last weeks have not made the U.S. headlines at all. And in the People's Bank of China, just as they did this once again in 2010 or 2011, they did it again recently. They're allowing the regional banks or the banks in China and people that have accounts in China to make direct purchases of physical gold or to buy gold at a 1-to-1 ratio. So they can now go to their checking account and make small allocations to gold. That's not a gold bug apology or a gold bug discussion, although that certainly will increase the demand for gold. But what it really says politically is two things. First, it says the Chinese are seeing longer term with the US dollar and currencies in general are going to have less punch. They're trying to build a moat and protect their much larger middle class. They're making policies to protect that growing industrializing middle class in China at the very same time that the US policies are kneecapping the middle class. So politically and optically, you're seeing a Chinese government that's actually trying to preserve the purchasing power of their citizens' currencies while we debase and inflate away ours. In the meantime, the other thing that message is sending from China is that, look, longer term, if China is allowing people to buy gold, imagine if you go to Citibank or Wells Fargo and buy gold. It won't be allowed. America's afraid of gold. It's an existential threat to the US dollar. But here's a country and here's a central bank that is trying to support its middle class, where our central bank is doing the exact opposite. Our solution is more QE at some point, and more central bank digital currency and more platitudes, but no real protection for our currency. So I think it's an interesting development. It's beyond just the gold conversation. It's about one country playing 10 years down the road as opposed to 10 minutes down the road to stay elected. The Chinese are actually worried about the purchasing power of currency, and they're encouraging the classic asset, gold, to protect and ensure that purchasing power. And of course, that's not making the headlines in the US at all. It's just another example of the Chinese being 8 steps ahead of us. It's crazy.
is not making the headlines. And one other thing that isn't making the headlines, if you look at purchasing power parity, the BRICS nations have actually eclipsed, if you look at, the combined GDP of the BRICS nations and the G7, the BRICS nations have higher GDP as a percentage of global GDP and with respect to purchasing power parity. So it's not like this is a small deal. There are, these 5 nations and their alliance is growing. Other nations are wanting to join the BRICS nations, and these countries with very, very large growing economies are moving away from the US dollar. They're developing a new reserve currency. So can you expand on the importance of this?
Yeah, it's absolutely important. And this was, again, something that came out in the Goldberg Trust Report, some of that data. It's fascinating. People say this de-dollarization kind of clickbait theme, this fear of the end of the dollar is the world reserve currency. But it is actually, you don't need to go clickbait. You don't need to scream the end of the dollar or the end of the world reserve currency to still be very serious, because the facts as they are, the sober facts are very sensational in and of themselves. I mean, the world reserve currency status of the dollar is not going anywhere. The Chinese bond market and rule of law is not going to allow the world to switch suddenly to the renminbi and the Chinese yuan. It's not going to happen. But what is happening, it's been happening since we weaponized the dollar and since we froze Russia's FX reserves, and since the rest of the world finally had the excuse to distrust this dollar after years of importing U.S. inflation. We're finally seeing the pretext to this multipolar, bipolar economic system that includes the BRICS in one camp, what's Christine Lagarde called competing camps. But Pozar is correct. You're seeing one block, which is Eurasia, the Belt Road Initiative, which is obviously China, Asia, the Middle East, Africa, and parts of Europe, which are going more towards the renminbi and the Chinese yuan and gold. Well, the West, the G7, is sticking with the dollar and probably central bank digital currency. Which would you pick? A gold-backed or gold currency that Glassiev and Babok are building right now in secret. We're going to see that in the next year or so. We're going to see a more gold-backed trading system in the East. And in the West, we're going to have debased fiat currencies and maybe centralized digital currencies. Which is playing the long game? Which is playing the short game? And people say, yeah, but again, the dollar is still the world reserve currency. The G7 is super strong. But as that graph that you indicated makes clear, as a percentage of GDP, the BRICS, they matter. Those BRICS economies do matter. Their natural resources do matter, and their trading policies and their trading settlement currencies do matter, because the West has been living off the past and its world reserve currency status with the dollar and its partners with the dollar. But meanwhile, slowly but surely, and again, it's not overnight, there's 41 countries looking for bilateral trade settlements outside the US dollar, and these are BRICS plus countries. And that's not a small thing. Again, it doesn't mean the end of the US dollar. It doesn't mean the end of the world reserve currency. It means less demand for the US dollar, less trust in the US dollar, and less use of the US dollar as a trade settlement currency. And again, when you add the BRICS plus nations and you time that in with everything else that's happening with gold purchases by central banks out east, central banks, last year, 2022, saw a 150% increase in central bank purchasing of gold. I mean, there's been net increases since 2010 by central banks, but you saw a massive dumping of U.S. treasuries and a massive purchasing of physical gold by central banks, mostly Eastern central banks. And why are they doing that? Again, it's not sensational. It's not conspiracy theory. The world is seeing, and they're prepping for a world not where the dollar disappears, but where the dollar is less important, less needed, and less valuable. And when it's less in demand, it'll be less powerful as well. So we'll see gradually, and there'll be peaks and valleys in the interim, in the DXY, et cetera. But the dollar is losing its status. It'll eventually lose its inherent purchasing power even more, not because the BRICS are going to be the reserve currency or the BRICS bank will replace the dollar or because the yuan or the ruble is going to replace the dollar, but because we're going into these competing blocks. And the West is terrified of this, and they're not talking about it. But it's happening right now in real time. And again, it's not the end of the world reserve currency. It's just a whole new normal in which the U.S. dollar is no longer the prettiest girl to dance or the girl you're forced to dance with because her father's there with a gun to your head. So these things are changing. And that comment you made about BRICS GDP, it's no laughing matter. And we kind of look down at the BRICS, but I look at, we look down at the BRICS, look down at Latin America or Central America, other parts of the world as banana republics. But if you look at the U.S. balance sheet, its debt to GDP ratio and its unfunded liabilities, I'm sorry, but the U.S. is a banana republic balance sheet. And that is our own fault and the fault of our leadership and our centralized control. It's not sensational. It's just the sad, like all empires, slowly fade out. And I was talking with Alistair McLeod about this in Frankfurt a couple of weeks ago. He came from an empire that was England. His father raised him in Kenya when they had the colonies in Africa. And look what he's seen in his lifetime. And I just see it. And I walk through Spain, London, Frankfurt, France, Switzerland, even parts of Greece. The world is changing. Whether you're talking to a cab driver, an expert, a high net worth, or a single parent, the world is changing. The interest in the dollar is changing. The pain of inflation is changing. The West is changing. It's not the end of the West, but it's palpable. It's definitely changing. And the data supports it. The headlines and the pundits don't want to talk about it, at least the pundits that work for the Bureau of Labor Statistics or the Democrat or Republican Party or whatever mouthpieces in charge of a corporate-owned media. Again, you have to go to alternative media to sift through the good, the bad, and the ugly to find just straight, factual data. And I think this In Gold Trust report is replete with incredibly good data, like that graph on the BRICS.
No, definitely. I know we've had René Stoiferle on the show before. Very good report there. I'll put a link in the description of this video here to it, as well as your articles. Quick question before we let you go. This current state of the gold market, I know we're seeing a bit of a pullback here, but as you mentioned, it's important to look at the long term, 10 years down the road. Where do you see things heading?
Look, it's no longer just the gold bugs. Look, whether it's Paul Tudor Jones or Druckenmüller or Ray Dalio or Jim Rickards, obviously, or Egon von Greyer's or myself or Ronnie Sturfula. But look, it's becoming slowly more seen as a reserve asset, as real money. And again, we've been arguing this for years because we look as investors, not traders. You can look at the technicals. You've got a cup and handle formation between 2011 2020 with the cup, and now the handle between 2020 2023. On the technical side, it's screaming a long-term trend north for gold. But I look at it just more simple, stupid. Again, as an investor, I don't care about gold price when it reached its all-time high a couple of weeks ago or when it dips down under 1940 today. I don't look at it. I just see the longer-term trend. I see central banks purchasing gold. I see China opening up retail accounts in their banks for gold. I see Eastern nations stacking gold. I see Western central banks stacking gold. Not because gold is going to be the new reserve currency or because the US dollar will be gold backed, but because each individual institution and in some cases trading partners are going to become their own central banks. They're going to back their own currency, whatever that is, with some gold because they see the long-term trend. Again, since 1971, every major currency has lost greater than 98% of its purchasing power when measured against a gram of gold. You can't say that enough. You can't repeat it enough. It's not a gold bug excuse. It's just an empirical fact. Yes, gold rises and falls in the interim, and you see super steep hikes and then major falls, but it always stays above 1,100, especially since the Chinese opened gold to the retail clients back in 2010. Gold has never fallen before that price floor. So gold can still be volatile. The trend is clearly up into the north. For gold to even have a 2x move, which we've seen in Bitcoin every other day, for gold to even have a 2x move, given that it's 5% of all kind of assets owned by investors, the price moves are going to be amazing. And again, as Rick Rule said about silver, and I'll quote him again, precious metals reward infrequently but extravagantly when you're looking at purely in price appreciation. But I don't measure, and as Egon says so many times, whether we measure it in euros, yuan, peso, kroner, Swiss francs, or dollars, or it's irrelevant because I'm measuring it in terms of kilos and grams and ounces because those currencies are just getting weaker. Gold is a constant. It just sits there and stares at you and you pay a fee for it. So it insures you against dying currencies. And I would love to see, and I know the milkshake theory talks about how the dollar has this demand for the euro dollar and demand through derivatives market and demand for the US treasuries as collateral for derivatives. The dollar's not disappearing and it can still get stronger. But the US can't afford too strong a dollar because then its treasuries become unloved and dumped. And it doesn't even want too strong a US dollar. But at the end of the day, it's a fiat currency. And history confirms that all fiat currencies face the same fate. And this isn't 100 years from now. This is now. And yes, if the S&P tanks like it did in March 2020 or in 2008, gold can be sympathetic with falling markets for a short period, but it always has new highs after that. So if you're an investor, you look at gold very differently. If you're a trader, look at your Keltner bands, your Bollinger bands, look at your stop loss signals. But if you're an investor, I don't think I looked at the price of gold really in any kind of nervous way for years. None of our clients really do either. We've got clients from 80 countries. I talk to a lot of clients. The one conversation I don't have is where's the gold price going to be next week? It's interesting. I mean, we have high minimums. We have very sophisticated investors, but they don't look at the daily price of gold. All they have to do is look at the purchasing power of whatever currency they're coming at us with. They know it's getting weaker. And so it's a fair question. Many are looking at least new highs this year, sustainable new highs. Much will depend on unknown and known events that can still happen. But the trend to me, and not as a gold bug, but as a history follower, a cycle follower, and a bond market follower, the trend to me is up and to the right, longer term and consistently. And again, to me as an investor, I'm just an insurance salesman. I'm selling insurance for currencies, and I'm a landlord. I put that gold in the ground somewhere and charge a fee for it. I'm a landlord with an insurance policy. And yes, it's important to understand why you have that insurance and why you chose that particular apartment to lease, so to speak, to hold your gold. That's very sophisticated stuff, but keep it simple, stupid. Currencies are dying. Precious metals have been around for more than 5,000 years, They've been around for 50,000 years to preserve and to act as real money. So I don't think it's going to be any different now. I don't think cryptos, and I respect a lot of the crypto arguments, but central banks aren't buying cryptos. The problem with cryptos is their exchanges, whether it's FTX, which is an obvious joke, or whether it's Genesis or Binance. As Jim Rickard said, they're like computer chips. Where are you going to cash out? What exchange are you going to use? How are they going to be as a minimum exchange? Again, I don't want to see crypto sufferers. I don't want to see crypto investors suffer, and I hope they do well. And I've known many crypto multimillionaires who bought gold with their crypto cash. But despite these Cinderella stories, there have been more losers than winners in crypto. And like a casino, as Rickard says, the house always wins. I don't think cryptos are going to be the solution to ensuring against declining purchasing power. I think the argument behind cryptos is admirable, alternative currencies. I think a lot of people I know who buy cryptos that weren't thinking of macroeconomics, they were seeing a great speculation trade and making a lot of money. That's fine. And I hope I'm wrong. I don't need to make fun of cryptos to support gold, but I see a lot of risk in cryptos. I see a massive standard deviation. I don't see consolidation in it. I don't see other countries really. I certainly don't see central banks purchase it. And frankly, because cryptos are so smart, and because blockchain is so smart, and because it is such a threat to the US dollar, I think whether central bank digital currency becomes a norm or not, one of the major targets from the government is to go after coins like Bitcoin, fairly or unfairly. They're a threat to these dark forces out of DC and these new central bank policies. So I think it's a noble idea. I think it's fantastic technology, and I hope I'm wrong. I'm less worried about gold, that's for sure.
All right. Well, Matthew, we really appreciate your time today. If our viewers are interested in learning more, they can go to the description of this video, or they can follow your work at goldswitzerland.com, I believe. Can you tell us a bit about that? Yeah,
goldswitzerland.com is the URL. It's Matterhorn Asset Management. We're based in Zurich. Egon and I have a book called Gold Matters. It talks a lot about this. But right now, I think if I could recommend something you can download today is check out that In Gold We Trust report that Ronnie Sturfel and Mark Valek put together. It's a fantastic piece. It's a book. It's a bigger book than our book. But it's data sensitive, data heavy, but a lot of funny quotes in there and some great interviews and really, really simplified insights that I think anyone, whether you're high net worth, retail, whether you're institutional or private, it makes a really strong case, not just for gold, but it looks at the commodity markets, it looks at the risk asset markets, it looks at geopolitics in a very sober, I think, very objective way. So this gold bug thing can start to disappear. We can just start looking at things with common sense.
Fantastic. Matthew, once again, thank you so much for your time, and God bless.
Thank you, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.